Heller.
Mr. Chairman, thank you, and Madam Chairwoman, thank you for being here today, and thanks for taking time. I always find these to be very informative. I want to go back to Brexit for just a minute. The chairman brought Brexit up, and you also mentioned it in your opening comments. You said that a UK vote to exit the European Union would have significant economic repercussions. Can you go more into detail of what that means and perhaps what the plan of attack by the feds are, if in fact that were to pass 2 days from now?
So I said it could. I don't know that it would, but I think it could have significant economic consequences by launching a period of uncertainty both for the United Kingdom and possibly the future of European economic integration. Most analyses suggest it would have negative economic consequences for the UK and spillovers to Europe, more broadly speaking. I think the financial market reaction to the uncertainties that would be unleashed by that decision could result in a kind of risk-off sentiment that we would see impacts on financial markets, that we might see flight to safety flows that could push up the dollar or other so-called safe haven currencies. And I don't want to overblow the likely impacts, but we're aware of them. We will watch them and consider those impacts as we make future decisions on monetary policy.
Is there any reason to believe that if Brexit were to pass, that it would have an effect on the U.S. economy to the point that we'd go back into a recession?
I don't think that's the most likely case, but we just don't really know what will happen, and we'll have to watch very carefully.
What's the chance of the U.S. economy being in recession by the end of the year?
I think it's quite low. I think the U.S. economy is doing well, and although I've indicated that we're watching this recent slowdown in the job market carefully, my expectation is that the U.S. economy will continue to grow. We have seen a pickup, a strong pickup in consumer spending and growth in the economy. If the weakness in the labor market for the last couple of months was a reaction to earlier slowdown in growth, that looks to be reversing. I remain quite optimistic, and the kinds of conditions that have been associated in the past with U.S. recessions, often that occurs when inflation an economy's overheated, inflation has been quite high, the Fed has had to tighten monetary policy. We don't have any such conditions in play now. Households are in much improved shape, and while there are negative influences in the economy, particularly on manufacturing stemming from slow growth abroad, the strong dollar, lower commodity prices, very seriously depressing hiring, causing job loss in the energy sector, and slowing investment in drilling and mining. Still, overall, the U.S. economy has been progressing even with those negatives, and I think the odds of a recession are low. It's certainly not what I expect.
Chairman, thanks for your answer. A week ago, Friday, I think the 10-year yield on Japanese bonds and also German bonds were negative. What impact does that have on our Treasury yields with these investors obviously looking for any kind of return coming and buying up our Treasury bonds? What kind of impact is that going to have on our yields?
So it does tend to induce capital inflows into the United States, which push down our Treasury yields. So ours are considerably higher, but in absolute terms, they're really quite low. And differentials in the stance of monetary policy also put impacts on the value of the dollar. The dollar has gone up around 20% against a broad basket of currencies since mid-2014, and that's had a negative effect on our trade with the rest of the world and put downward pressure on corporate profits and hiring and manufacturing.
Are you concerned that if feds raise rates, that bond traders will ignore that? In fact, reversing exactly what you're trying to achieve by raising rates?
Well, I think one of the factors that does influence bond pricing, if this is what you're referring to, is the anticipated path of rates. And there's some further increases built into market expectations, and often the response of bond markets to what we do depends on how our actual actions compare with those expectations.